You don't need a system outage to know when your PPE isn't delivering what it should. Maybe pricing takes an extra step to verify, maybe updates are taking longer than expected, maybe your team has built workarounds just to keep loans moving. What starts as a few small delays can gradually become the way the work gets done. The reality is, a modern PPE should do more than provide pricing. It should deliver real-time accuracy, seamless workflow execution, intelligent automation, and the confidence to act without hesitation. It should help your team move faster, operate more efficiently, and focus on performance, not process. So ask yourself, is your PPE helping your organization perform at its full potential, or is it forcing your team to work around its limitations? Take a closer look at what you should expect from a modern pricing engine. Visit optimalblue.com/optimalblueppe. Again, that's optimalblue.com/optimalblueppe. Stop accepting friction as part of the process. Make sure your PPE is helping your team move faster, execute smarter, and capture every opportunity.
Welcome to Optimal Insights. I'm your host, Jim Glennon, Senior Vice President of Hedging and Trading Operations at Optimal Blue. Our clients and industry partners have long relied on Optimal Blue for trusted insights and commentary, and these podcasts are an evolution of our commitment to keeping the industry informed. Let's dive into today's episode.
Welcome to Optimal Insights, your weekly source for real-time rate data and expert capital markets commentary, brought to you by Optimal Blue. Let's dive in and help you maximize your profitability this week.
All right, welcome everybody. Welcome to this week's installment of Optimal Insights. Thanks for being here. We're here making sure you know what to watch, whether you're an originator, capital markets person, or just someone interested in the mortgage industry and some good market commentary. So we'll kick it off here in a minute with the market update. After that, we are going to recap two conferences that took place last week. Kevin Foley was at the HousingWire AI Summit down in Dallas. He was on a panel, or did a kind of a fireside chat with Sarah Wheeler there. He also attended all the sessions, so he's got some good insight as to what was being talked about there. Rhiannon Bolen and I were in California at the CMBA Western Secondary Conference. A lot of really good things happening there as well. That's a bit of a larger 700-plus person conference, meetings, but also sessions, just a good vibe there as well. So we'll tell you all about what the industry was discussing at Western Secondary. Before we get into any of that, just in the way of data, as you know, rates stubbornly high, 6.65, just for all the reasons we've discussed on this podcast over the years and will continue to today. Just a ton of supply out there, just a glut of government spending, AI spending, internationally, military spending. So just keeping government borrowing, which then influences mortgage borrowing, near some highs that we haven't seen in over a decade. The 10-year 4.7% right about now. So still solid 2-point spread between treasuries and mortgages, but again, elevated, stubbornly high. Yet we're continuing to see decent volume. We are roughly 15 to 20% above where we were this time last year in terms of volume. I think certainly at the MBA Western Secondary and the AI Summit, just discussions around that in general, just the health of the mortgage industry and how we just continue to see organic growth over these past couple of years, despite the massive headwind of just rates being high. So let's get into it, gentlemen. Welcome, Alex, James. Thanks for being here, as always. Where do we want to start the conversation? So we start with inflation. And that's the big numbers we saw last week, right? And that's heavily influencing what we're going to potentially expect from the Fed.
Yeah, last week's releases definitely continue to put us in kind of a flip-flop mode if you're following the CME rate futures. The CPI number was right in line with expectations, only up 1.1%, which left the year-over-year number around 3.4% and that core number at 2.5%. So about where we were before the war in Iran really kicked off. Really, I think this can be directly attributed to calm energy prices throughout the month. The active hostilities in the Middle East, as the entire month was encompassed under the Memorandum of Understanding. Little headlines here or there, but for the most part, there was no active fighting, which led to energy prices on that CPI number declining by 1.5%, and gasoline, the price that you're seeing at the pump, declining about 2.9%. So that helped to keep the CPI number entirely in check and continue to have the market begin to kind of push again towards the labor market picture.
Yeah, it's just continuing to read interesting things, interesting articles about where the war goes from here. And obviously that all affects oil prices, which then inflation and then interest rates. But I was reading one yesterday. I need to read it again because I still don't fully understand it, but it had to do with there's a chasm between it's seemingly the expectations of Iran versus the U.S. as far as where the war goes next. Like Iran has been gearing up for this next stage of the war that they feel is going to be even bigger than anything we've seen yet. But it feels like on the U.S. side, we're thinking it's more of this back and forth of, memorandum of understanding, relative calm in the strait until there's an attack, and then there's a retaliation attack, and it's just this kind of cat and mouse back and forth that's been going on now, for over 5 months. But yet there's this thought, which seems dangerous, on the part of Iran, that there's going to be like a massive escalation at some point. So I think it's a war, right? It's expected that competitors are going to have different ideas about what's going to happen next. And you hope that this is a chess game, not a game of checkers. You hope it doesn't devolve into something even more destructive than what we've already seen. But anyway, I just think that it feels like something will change here in the next 30 days regarding this war that could potentially be either disastrous or hopefully something that really positive that starts to move back into a direction of some sort of peace, some sort of, economically, maybe better movement through the Middle East for goods and oil and gas and all of that. Anyway, I just put that out there to say, if you haven't gone out there and if you've kind of been lulled to sleep by the slow back and forth, it's worth reading what some strategists are thinking may happen next in the conflict.
Jim, I have heard the speculation on, September and October are going to be particularly dangerous for United States service members over in the Middle East because we are entering the election period for the midterms, and that is not lost on Iran. They know this. They would rather be dealing with a party that would like to come to a quick conclusion to get out of this. And currently, like the Democratic Party is going to push back against anything that Trump has done. And so from Iran's perspective, they may prefer them. Generally in politics, an October surprise is something that helps boost or pull away from a candidate. So, as Alex was just saying, as this has been a little bit more calm, the memorandum of understanding over the past 2-3 months, prices have come down a little bit. If things were to escalate again, or to just get a little bit riskier again, that would push energy prices. And if there was to be something catastrophic to happen for American lives, that would be politically bad for the current incumbency. So it's definitely a dangerous period, and it's kind of a dangerous period inflationarily.
Yeah, two things I want to take note of right now. As of the recording here, Monday, August 17th, the Memorandum of Understanding expired last night. The 60-day period expired last night, Sunday night. And then the other thing that was really dominating the news cycle here in the U.S. in regards to the conflict was Trump posturing that they're going to, rely less on military force and begin to really slam them with economic sanctions. Not to say that Iran wasn't already under pretty crippling sanctions, but I think them publicly coming out in favor of new sanctions strengthens the case that you're making there, Jim, that, from the U.S. side, we would like to take a bit of a step back, at least through the election season, to James's points that they want to keep this relatively low on the radar, keep the energy prices moving in the direction they have been, at least through, October.
Right. I think it was Secretary Bessent that came out and said that we would see economic sanctions never before attempted or seen on Earth, is kind of how he put it. So I'm interested to see what that is. I don't know that there are details of that yet, but that would be, I think, what you're referring to, and hopefully a less violent strategy But it does feel like, as you said, James and Alex, there's a deadline at this point with the election coming up. And hopefully that doesn't mean American lives or anybody's lives are at stake. And certainly, hopefully, we don't end up in another round of inflation. And that, as you said, that's going to hurt the administration in power at that time, which is obviously, currently the White House and a mostly Republican dominated picture, right? So going into the election, that it's just going to be uber sensitive, but escalation could make the situation worse at this point. Okay, what else do we have out there? So as far as, in terms of the Fed, the CME futures seem to bounce around quite a bit depending on who has recently spoke, what happened at the most recent FOMC meeting, what the most recent inflation numbers look like. I think now we're leaning towards another pause in September, right? Where we potentially had a hike on the board just a few short weeks ago.
Yeah, it's incredible how quickly things switch, right? The job numbers coming out this month were finally looking a little worse for wear, and the inflation actually looked a little bit more under control, quite quickly pivoting from where we were, a month ago. With those two flips, it does show that we were more likely to have a pause, just hold on a little bit longer, tread the water, and our new Fed head, not wanting to step forward and communicate, say as much, throws questions on what people can expect. So we've been leaning that perhaps we will, see the pause, stay assuming that there's going to be a pause rather than a hike is the safer option. So we're at about 70% chance that we'll see the pause with only 30 days to go. So, plenty can switch in that time, but that seems to be shaping up. We're keeping where we're at.
Yeah. We'll have another jobs number that's going to come out in a couple of weeks. And as you said, just anemic, right? There's not been a ton of jobs created, but the unemployment rate has stayed low. Then you've got, with gas prices coming down, inflation is a little bit more in check. But then rates have been slowly creeping up, certainly in July and the first half of August. So it's almost like the market is solving some of this. It's doing the heavy lifting for the Fed. Like rates are up. That's going to slow down growth, expansion, and that's happening, right? So it's almost as if the Fed doesn't need to act. The market's just getting it done. We were at 4.5 on the 10-year a couple of months ago, and now we're close to 4.75. So we basically had a quarter point hike that's been inherently just built into the market.
Right. And the question remains is how long will the market continue to believe this hawkish posturing from Warsh before it backs off? The market wants lower rates. And if there isn't that baseline change in the federal funds rate, it'll make its way back down if the Fed doesn't deliver on what the market is expecting.
Good call. So meanwhile, just changing gears slightly, how's the housing market holding up during all of this? For first half of the year, you have, lowest rates we had seen in a long time. We found a 5 handle right before the war. Volume was up. That was helping spur all sorts of lending, refis, in addition to making homes a little bit more affordable. But now we're up closer to 6 3/4. Refi lending has certainly slowed down, but continue to see some activity in the purchase market, and starting to see very much a leveling off, or even are we even seeing deterioration in housing prices? Like what are the main shifts happening in the housing market right now that we should be paying attention to?
Yeah, if you're looking at Redfin's numbers, which came out last week that I wanted to highlight today, it seems that in most areas of the United States right now, it's more of a buyer's market. They're seeing 51% more sellers than buyers, which indicates the favors to the buyer. There's more houses on the market than there are people willing to buy them in a lot of these areas. It seems to be led by some of the COVID hotspots, like the Miami market, Texas. Those are some of the places with the greatest discrepancy between sellers and buyers. But overall, there's a little under 1 million buyers out there right now, in the 900,000s. And Redfin observed close to 1.4, 1.5 million sellers right now. So, several hundred thousands of homes across the nation. And you really, at the end of the day, you got to look at it at a metro level, just because those are matching markets. But overall, it does appear, outside of a few suburban locations in the Northeast that right now, if you're buying, you probably have a bit of leverage.
Mm-hmm. It was bound to happen. We needed a little bit of a breather, and it, to your point about more sellers than buyers, it would appear that we're in one of those markets where sellers may be feeling like they're in danger of missing the boat of the just massive appreciation we've seen over the past 7 years, and trying to liquidate on some of that before we start to potentially see a correction in the housing market, which we've seen in some cities, to your point, depending on what metro area you're looking at. But if we continue to have that imbalance, you probably would expect in this type of market, especially with rates as high as they are, that we might see a bit more downside to housing prices over the next couple of years than we would see upside. Does that kind of make sense?
Yeah, that seems to jive with what we're observing right now.
So covered the housing market, covered the Fed, covered inflation. Yeah, I mean, what are we in for the rest of this week? It is third week of the month, typically not the most active in terms of economic indicators, but what do we have? We have initial claims, as always, on Thursday. And then there's some home sales data coming out right before this, or right when this podcast drops, right?
That's right. It should be right 10 a.m. Tuesday morning. We'll see pending home sales, which will be interesting just after, Alex saying with the Redfin data, whether the rest of the market is really fully bleeding that in. The only other item really to look for this week is the FOMC minutes will come out this Wednesday. On the last opinion, there were 3 dissenters. So curious to see what they had to say, but based on the inflation, the jobs numbers the past month, they may no longer be dissenting and voting for a hike. I think probably 30 days we'll see a decent consensus to stay where we are.
Mm-hmm. Makes sense, yeah, for all the reasons you mentioned earlier. All right, gentlemen. Thanks again, Alex. Thanks, James. Great podcast. Talk again next week.
Talk to you.
Thanks, Jim.
Thank you.
See ya.
All right, everybody. Please join me in welcoming Kevin Foley and Rhiannon Bolen, my colleagues here from Optimal Blue. How's it going, Kevin? Rhiannon, thanks for being on today. Thanks for doing this podcast recording with us.
Hey, Jim. Thanks for having us.
Great to have you. Interested in what everyone experienced last week. So we were all at conferences last week. We're kind of getting into that fall season almost, even though it's still 90 plus where Kevin was, 100 and something degrees. Kevin was in Dallas at the HousingWire AI conference, and Rhiannon and I were at the CMBA Western Secondary in the LA area in Terranea. Beautiful venue, by the way.
I think you guys won the weather competition. Yeah.
It's definitely a brave time of year to have a conference in Dallas. That's a great venue as well. I mean, that George Bush Library is a very cool spot for a conference. HousingWire does a lot of stuff there. Just a neat little, venue, cool history there, and I like the way that bowl-shaped theater is just kind of cool. It almost feels like Ford Theater to me, which I thought was.
It's very intimate.
Yeah,
it's really
It's tight, but the way they run a conference, I feel like everything is front and center, and everybody they run on time. Like you really can't break out to take a call. You're going to miss something important. They do a really good dense conference. So why don't we just start with that? So Kevin, you were at the HousingWire AI conference. You even had a session there, which I'd like to get to later. But what was the general vibe of that conference, and like what was it about besides just AI?
Yeah, great question. I think the folks at HousingWire always do a great job of getting a ton of interesting people all in the same room, and they have various conferences throughout the year. I was at the AI Summit last year as well, so this was my second year. But overall, I think the vibe is good. I think this year in particular, there are less people out there who are in that how do I get started mode. A lot of folks have already gotten started. They've started down their AI investment, AI implementation journey. But there's still a lot to learn from folks who have kind of gone through that investment cycle already. I talked a little bit about that, but there are also some great speakers talking about how to better educate folks within your organization on AI, how to build your army of AI capable folks cross-functionally, cross-departmentally, and just a lot of good anecdotes from the field. So overall, really great day. Very, very excited to be there.
Great. Yeah, I mean, on that, I always have questions about adoption of AI and how fast it's really happening and where that AI lives. So, at Optimal Blue, obviously, we build a ton of practical and interesting AI tools for clients to use that are, again, useful for their daily lives, making their lives simpler. So in that way, mortgage lenders are employing AI through Optimal Blue. Are there other tools that they were talking about there where lenders are employing, I don't know, building their own AI tools internally, or does it make more sense? Is it more scalable to utilize your partners to get AI in the hands of your employees?
Yeah, so there's always conversations around build versus buy when it comes to AI, and I think the way that I would think about it, if I'm a lender, is there's no use spending or investing your own dollars to solve problems that your vendors are already out there solving for you. So it all kind of comes back to what are the problems that you're trying to solve. And and this has been kind of the way that it's been with AI since the beginning. Is everyone's AI, I've got to implement AI. You actually need to start with what are the problems within your organization that you want to solve, and AI might be applicable for a number of those. And so when you start that way, it's always helpful to understand what your vendors are working on, what capabilities they have, because if your vendors are out there and spending their dollars to solve their problems, you don't want to duplicate that effort. If you can get that as part of something that you already have, a relationship you already have through that vendor. But there certainly are some unique use cases where vendors, in generally speaking, I would say building that internal AI capability within your organization is going to have compounding benefits no matter what.
Kevin, I was going to ask, I don't know if you saw this at the conference or not, but I feel like when AI was sort of surfacely introduced into the mortgage industry a couple years back, it was kind of a scary thing, and people were very concerned about, what it would do to jobs in our industry. And I feel like, at least in the last year or so, we've kind of transitioned from being a little less fearful and more. It's become more about, we know that we have to use it. It makes our lives and our jobs more efficient. It's not necessarily going to replace the job, but it can just make us produce, loans and manufacture loans more efficiently with less errors. And I think people have just kind of collectively, in the industry at least, adopted it or trying or moving towards adopting it and are not as fearful as they used to be. I don't know if that's what you're seeing at a conference like that, but that's kind of how the general perception is these days, it seems like.
Yeah, no, I think you're spot on. And I would even argue you kind of have the fear and anxiety at both sides of the spectrum. You have fear from folks around, is this going to, take my job or replace me in some way? And you also have fear and anxiety around, oh my gosh, if we don't, maybe more from your C-suite, oh my gosh, if we don't do something around this, we're not going to make it. We're not going to be able to be competitive and survive it.
Right.
And I think a lot of the fear on both sides of the spectrum are somewhat overblown. Like, we're all going to, it's not like unless if you don't invest, and hire a ton of AI, specialists in-house as a lender in the first half of 2026, you're not going to make it. That's not really how things are right now. And the other side of the spectrum is we've found, and we find here at Optimal Blue, AI works best with human in the loop, where you're using it as a force multiplier for your existing employees' capabilities, and we see that every day. So, but I agree. I think we're sort of converging around this area. When something's new, when there something seems risky, and we don't really know a lot about it, it's natural, I think, to be fearful, skeptical, all those things. But any new generational technology, the advancement of the internet, sooner or later it just starts to seep its way into your daily life, and you almost sometimes don't even notice that it's there, particularly when it's done well. I think that's definitely the trend that we're heading towards, in my opinion.
Yeah, I mean, our industry has almost always been a series of booms, right? refi booms that were kind of at the behest of interest rates or any sort of market disruption, whether it was the COVID or the great financial crisis, or even some of the interim periods like when the Fed was tapering off of QE, we had a disruption there, 2013. This sort of thing came up in the session I was in quite a bit. And the point was just you have to be ready, right? There will be another event that causes volume to go up 50% or 100%. And back in 2020, we did not have AI anywhere in the industry, and we had to add humans quickly to the process, as we always have for decades. So the thought is this time around, even if it's just organic, like it's happening now, we're likely going to have higher volume this year than we did last year. At this point in the year, we definitely do. That's going to continue. We're going to continue to increase and come out of this sort of small mortgage recession that we had. And how are you going to scale for that? Are you going to have to add people, or is AI going to help you just be more productive, to both of your points, and be more accurate?
Yeah, I think because to your point, Jim, like we have just been still coming out of a pretty significant contraction in our industry. And we had a lot of people exit the industry in the first place that had been around doing, whatever they were doing for a number of years and decided to retire or whatever. And to your point, the opportunity for us in the industry is, how do we replace a resource without having to add additional people? Because quite frankly, our industry is shrinking. A lot of people are aging out. And so there's, we have to pull in less experienced, younger folks and train them in our industry because they're not just coming out of the woodwork. So I think AI presents the opportunity for the industry as a whole to incorporate that. And I think a lot of us are accepting it, are getting to a place of acceptance now. And just figuring out how can we incorporate that into the workflow and make it to so where we don't have to add as many resources as we may otherwise have to when we start to expand a little more. So
right, totally agree. Yeah, it's like anything else. There's sort of this natural progression of, like you said, acceptance, and then really starting to learn, how can I use these tools internally? How can I make the best of them? Which one should I be using? Like, where does it make sense to implement AI versus looking everywhere? So at the California Mortgage Bankers Conference, Western Secondary, Rhiannon, you were there. It's a bit more of an industry conference in that there are sessions where there were some great sessions, some great speakers, but it was also a lot of meeting with clients. It's a bit of a longer conference than the AI Summit. But Rhiannon, what was your general takeaway from CMBA, the vibe, the general tone, but also some of the stuff that was talked about there?
Yeah,
including AI.
It was great. I will not complain about the view that we had, because it was a spectacular venue. And I have to commend Paul Gigliotti for, I think this is his first CMBA as the chairman of California Mortgage Bankers, taking over from Susan Milazzo. And man, what a great job. I think it was their highest attended event. I think they had over 800 people. Again, the venue doesn't hurt. But I think that it almost reflected like cautious optimism. And in the market that we're in, where we've had continued volatility, we're still not, back to where we were, where it's unlikely that we're going to get back to where we were. We're just sort of, trying to figure out where we're going to land here in sort of what is the new normal of the industry. I think that the attendance reflected cautious optimism. To our conversation earlier, I think, there's a lot of conversation around, how do I protect my margins? It's a primarily capital markets focused conference for sure, but there's a lot of C-suite individuals there, varying types of roles that you get to interact with. And a lot of the conversations we had were about that. How do you protect your margin going forward? How do you incorporate some of the resources and tools, advances in technology into your workflow so that you can adjust your resources accordingly going forward if we do get to another refi boom here, which we all hope we will at some point. So really good conversations. I know, just talking from the sales side of things, we had a lot of conversations with current and prospective clients about how they're thinking about the future, what their growth is. Tons of non-QM conversation. It feels like there's a lot of investors because, we're at a place where we're having to consider alternative types of products. And because the rates, are not cooperating, we're having to kind of get a little more creative. You see this expansion in non-QM, it's over 10% now. And so a lot of those conversations and investors in particular that are wanting to enter that space, especially on the wholesale side. And those were interesting conversations just to hear how those companies are setting up and how they're operating. Some of them are self-funded. Some of them have some kind of backing behind them, and they're focused on, securitizing. So a lot of really interesting conversations around non-QM and who's buying and who's selling that product. It was good. It was very interesting though, because I think it's going to be intriguing to see where the non-QM discussion takes place in the future.
Yeah, that's been a thing for months now, or years now, since the end of the great financial crisis. Is what addresses that additional 10 to 15 to 20% of the market that's not covered by conventional and government loans. We certainly, and it was kind of good timing, a good location. Like Southern California has always been a great place for creativity in the mortgage industry, let's call it. Right? So you're kind of surrounded by some of the largest non-bank lenders, and a lot of those are some of these non-QM investors. Was there much conversation at the summit, Kevin, about non-QM, or were they kind of solely focused on AI tools?
Yeah, I think AI is just sort of the major theme, but it came up a little bit. But I've definitely also picked up on non-QM feeling like the light at the end of the tunnel, or something that's sort of getting us through this more difficult time where we do have this expanding proliferation of additional options that you can fit borrowers into that are solving very specific areas where self-employed borrowers, where the traditional funding routes really aren't available. And it feels like that 10%, that's a new high watermark, right? Like post financial crisis, which is great. I mean, that we're finding ways to serve borrowers. So, but I'm glad that it seems like that was a good topic at CMBA. Was that kind of on your radar as well, Jim? Was that coming up a lot?
Yeah, I mean, you can't have a meeting with a client these days without that being at least part of the conversation. Whether they're honestly some still dipping their toe into the water, running some best efforts non-QM loans through a couple of the specialty lenders, and then if you're talking to even the big aggregators, they're deliberately rolling out their products and their programs into the mandatory space. That was a big conversation, which is starting to see some bulk bids come in for non-QM. And then it was, how do you hedge it? How do you trade it? Like that's a huge topic does not have a full solution to it yet. That's like best practice across the board. There's so many ways to hedge and deliver non-QM. And we talked to many very large lenders that are doing it very differently, which is what we expected to hear and what we're finding with our clients as well. But we came back with some good ideas how to even tweak our own strategy around hedging and trading non-QM and being able to tailor it to the size and the kind of objectives of any sort of lender out there. But yeah, I thought it was, there was not only a bunch, like several sessions on the subject, but also client meetings were not completely focused, but quite a bit of focus on
a lot of that talk.
Did you see the same, Rhiannon?
Yeah, and then you incorporate the credit scoring discussion into all of that, and how everything gets qualified, and that becomes a more interesting conversation, and how that's evolving, right? Some of that conversation as well. But yeah, I mean, and a lot of it just about workflow. How do you how do you become as efficient as you can be? And to your point earlier, Kevin, what are your partners doing around that, and how do you leverage those tools? That's always a big question. Is technology kind of moves quickly, and it lives and breathes, and as that happens, lenders have to be aware of what's forthcoming and what enhancements they can take advantage of. But the adoption question is a whole other thing, because if it's a big enhancement or feature enhancement that could potentially bring additional efficiency to the workflow, you have to incorporate that into your business. And how do you do that? And how do you roll that out to your organization, from the time the loan is originated all the way to the time it gets sold in the secondary market? So that's another big conversation as we continue to incorporate AI, as we continue to talk about to your point, Jim, hedging, non-QM, what does that look like for the actual process? And how do you incorporate that into your business and get everyone else in that organization to say, yeah, we're going to do it this way. And we all buy in, and here's the training, and here's the rollout, and hopefully it all goes perfectly, right? Which always says.
Yeah. As a product manager, if you're a lender, I'm begging you, read your release notes, please.
Right.
Those emails that come out that tell you exactly what we've been working on, and not just for us, but across the board. Those, I joke about that because they're sometimes the most boring email to read through, but once you get into it, it's all the exciting stuff and exactly how you can turn it on and do all those things. But it's definitely important to keep up on, and we are, this year in particular feels like there's all of these different topics du jour, with new credit scores, we have expanding non-QM, we've still got the AI proliferation happening. There's all sorts of ways for lenders to kind of dig into new things and see how that might fold into their overall strategy. So great things for lenders to be aware of.
Yeah, it comes back to, again, we have sort of a lull in the market, even though we're going to do better this year than last year volume wise, but there's a chance to get prepared for what's coming. So very first session, I believe it was the first session of the conference, Monday night, Chris George was up on stage with our old friend AJ, and he started out by saying the biggest mortgage market we've ever seen is coming. And I don't think he was rubbing his crystal ball. I think his point was it's coming. Like, it may not be 6 months from now, it may not be 18 months from now, but it's coming. We'll either organically grow into the largest market we've ever seen, or there will be an event that will cause it. So you got to be ready. You have to be ready and prepared with operationally, capital markets wise, your capital funding, all of it, like your ability to grow. So the session that I was in was the very last one of the conference. Shout out to everybody who hung out long enough to see it, by the way. Thank you. If you stayed at Terranea till like midday Wednesday. But our whole session it was called the last trade, or the final trade, sorry. And it was basically our whole thesis was be prepared for the next thing that's coming, whether it's a market event, a government regulation, new products, new types of funding. Like we had a bit of a discussion about blockchain and easy access to capital that way. My part of it was obviously capital markets. It was each time we've had one of these events, it's sort of the event sort of favored one execution type or another, right? In 2020, it was if you couldn't retain servicing in 2020, you did not do as well. You were not as successful as those that could retain servicing. And obviously in 2008, if we go back that far, if you weren't able to originate conventional and government loans, you got into some trouble when all of the non-government and agency products went away overnight. It was, again, just be prepared for that next thing. And that means implementing AI and automation, having access to good data that you can use to be competitive, managing your margins more deliberately, like all these things that everybody kind of knows in the lexicon you're supposed to be doing. But I still think we tend to get busy and we procrastinate in implementing some of these things. But we know that if and when this next event comes, it's going to be too late. You're not going to have time to implement these tools. You're going to end up just having to hire FTEs, and therefore you're not going to be as successful as the more prepared lender that was able to scale without adding bodies to the organization. So this all sounds obvious, but I feel like as an industry, we still tend to lag in adoption of certain things, and we tend to just kind of live or die by volume, and we don't invest early. We just wait for stuff to happen. So, and we don't read the release notes, right? Because
read those release notes
happening so quickly, right? Even with OB, for Compass Edge, we have releases every 2 weeks, I believe. For our PPE, it's at least once a month. It's like you have to stay up with what's new, or you're going to miss it, or you're going to wonder where it is later when you need it. So.
And, it's complicated, right? I mean, the manufacturing of a loan is a multi-step process that involves multiple divisions within an organization. And we are the most highly regulated industry almost out there. So it's a complicated endeavor, not making light of any of that at all. But it is one of those things, like even just in school mortgage banking, we teach how critical it is to really consider your process for acquiring technology, adopting technology, and in this day and age, if you don't have an individual or a department that's their focus, that their whole focus is to make sure that the release notes are reviewed thoroughly and you're taking the enhancement in accordance with what you can accommodate in your process, or thinking in that way and considering, different ways that you can produce a loan, either using the current partners that you have or considering new options for technology. It's new to our industry. We didn't ever have to have that kind of a persona or a role within our organization, not but just a couple of years ago. So it's a complicated endeavor for sure, but it's really critical. And you can, as a lender, you can lean on your partners to help understand what it can do for your business, and hopefully you're leveraging their expertise, as it were, yes, to adopt it, because they are the ones that know that technology inside and out. And so I think a lot of times what happens too is you have this opportunity to take this feature enhancement and you decide you're going to go about doing it in such a way because this is the way that you as a lender always have done things, and then it inevitably has some challenges when it gets rolled out. So just having a really good partnership with your technology providers and relying on their expertise to help you gain adoption within your organization, I think, is also a really critical component of how I think we're going to all perform collectively going forward, especially when the wave does come back.
Good. Those are both great points. And I think, to paraphrase, as partners, we and other partners are obviously going to do our best to help you understand new features and new enhancements in the technology, and we will suggest best practices on how you should implement them. But within your own within the lender organization, it is also, I think, well worth the FTE to have at least one expert, if not more, on many of the products that you are using, so that you understand exactly how you want to implement it within your organization. You're going to know your organization better than anyone. We strive as partners to understand it inside and out, but having someone internally that can actually move the wheels and say, okay, this is a tool that we're definitely going to be using. Here's why. Here's the people, the stakeholders I need to bring into the room and explain it to them and make sure that they're using it the way that, Optimal Blue, whoever explains to me that it should be done.
I think great points all around. I was going to kind of segue into talking about your topic, Jim, staying on the cutting edge and, understanding, preparing yourself for the next environment, kind of a lot of crossover with what I spoke a little bit about at the AI Summit with Sarah Wheeler, which was all about, that sort of similar frame of reference, but, on AI and what is the latest that's happening in the AI frontier? How does that impact our industry? How can lenders be better prepared to take advantage of that? I think some of the major points that I wanted to make is, I think that the models themselves, AI models themselves, are good enough to solve all the problems that we're trying to solve, and really have been now for, I would say, since maybe around the beginning of the year is when I think that the quality of the models really became excellent in solving more complex problems. And now a lot of the value in the mortgage industry, in my opinion, is moving away from the models and the frontier and, the things that are happening with Claude Mythos and Fable and whatnot, because a lot of those frontier models, if you have access to them, are kind of pricing themselves out of the equation, and instead using more budget-friendly models in constructing a harness, which is really a scaffolding that you put around the model to help it perform very specific tasks to solve specific problems. That's where the value is living. You've got the brain power already, but the models themselves are generalists. They don't understand your specific business, the specific systems that you're using. But you don't need a powerful frontier model with a huge budget to solve those problems. You really need a cheaper model with a really good harness. And those harnesses, that's your proprietary infrastructure. That's your proprietary technology. And you can build a really fantastic harness for your specific business, and that can become a moat for you. That's where the moats in AI, I think, live. much more so now. And there's, all sorts of ways I think that the moats around, certain businesses or technologies are changing with AI, but it really gives lenders a great way to prepare for the future by focusing much more on the harness, which is where the value is now, compared to trying to chase what the latest model or model provider is doing.
Right.
It's interesting. It's almost like the lenders need to have a harness or a moat administrator now.
Yeah.
Yeah. That would
that's
be
a big part
of
a big part of the strategy, right?
Yeah, absolutely. So the more that you can focus on providing your own institutional context, your alpha, your competitive, what makes you a competitive company in a competitive market, the more that you can serve that up for AI, that just amplifies your capability and your competitive edge, in my opinion. And so that's, certainly that was the topic of the conversation, some of the main points I wanted to get across, but also just things that I'm focusing on as part of, my role. And, we also talked about the launch of the Virtual Economist, our AI and machine learning powered forecasting tool for interest rates and lock volume. That went to general availability last week, which we're really excited about. We launched our new AI labs here at Optimal Blue, which I'm very excited to be helping stand up and get off the ground. Yeah, which is going to be,
it's awesome.
Yeah, a very exciting new adventure for me and for Optimal Blue. But yeah, it's a really exciting time to be in the space for sure. There's always exciting things to be focused on in our industry. Something that I've learned during my time for sure.
Very good. Yeah. No, thanks for bringing that up, Kevin. I definitely wanted to get to the session. It sounds like, great thesis on your part around the moat strategy, but also sounds like you all covered quite a few topics around AI with Sarah as well. So sorry to have missed it, but sounds like you as always, represented Optimal Blue very well. Appreciate you doing that.
Yeah, likewise.
Let's see. Why don't maybe we wrap it up with anything that surprised you at these conferences that you attended. So start with Rhiannon, just off the cuff, anything that was either a highlight for you or just something that you were a little bit surprised by that you heard or saw or witnessed at the CMBA.
Yeah, I think I kind of mentioned it when I started talking about the conference, but I think just the sheer number of attendees in what is still sort of a volatile market and with still some lingering uncertainty about where this is headed and, rates kind of being uncooperative. I think that number of attendees there really showed that as an industry collectively, we're all focused on trying to, progress forward and figure out how we do that the most efficiently and with the protecting our profitability along the way, as well as just what can we do to provide products to consumers that fit the needs of the modern home buyer these days. So I think that's maybe not surprising, but enlightening a little bit about where our industry is going and that people are really invested and wanting to learn new and different ways of doing things.
Agreed on the attendance piece, and that kind of dovetails into the curiosity and the collaboration as well. People show up to these conferences to get value out of it, right? So yeah, I think it was 700 plus that attended, which post COVID, it's impressive that at this point we're finally back to better numbers than we saw pre-COVID. It felt like there for a while and still feels like it sometimes that some folks have become unwilling to travel or just travel less, whether it's because of budget or just the ability to be remote has just increased and the ability to access content like this podcast and others. But people still see value in in-person conferences like this, whether it's to visit face-to-face, which I think will always be important in business, especially with AI and other things that are not quite reality, but also to learn, from the sessions and to take part in some of those sort of learning activities. I think is that's
a good point.
Encouraging.
Yeah, face to face. I think people are craving that. Honestly, these days,
yes.
I think people want to sit down, and talk to someone, look them in the eye. I think that's great. I agree with you. I think it's the way we make more progress that way.
Yes. So you build a little bit more trust there, right? And you let the guard down a little bit more. It's just, there's something
We're a
about it.
relationship business. We still are a relationship business. That's not going to change.
Right. How about you, Kevin? What surprised you, or what was enlightening, or what was the highlight of the AI Summit?
I might take the same answer and say I think one of the surprising things about AI and some of the insights are that it's really a people focused conversation, and some of the most interesting anecdotes that I listened to were about people and about building your internal employees' capabilities, sourcing ideas from your people on what to build to solve specific problem, listening to your customers, listening to your employees, to the folks who are if there are problems to be solved with tools, like talking to the people who are using those tools every day. That is still where you start with AI. That is the most important place to start. And it was a good reminder listening to some anecdotes that this isn't really a technology. I think the way that we use it, that's going to be taking people out of the equation, and it's so fundamental to what you're doing. So I'm going to piggyback off of the same answer. It's really, I think, a great enlightening way to kind of remind yourself where you are and what is really important in your business, and it's all about the people.
Good. Yeah, I'll stay in that same realm as well, because I think it's a bit of a broad brush that I'll paint it with, but very similar. It's the amount of people that were there, the generally positive mood that everyone was in, the sort of, there's no more hoping and waiting for rates to drop. It's strategies that are around what's going on today and what hopefully will happen as the industry continues to recover in the future. It was, a lot of it's curiosity. I think a lot of people showed up because they were curious. What are people going to be talking about? What are the new features that are out there that I'm not aware of? Because things are moving so quickly at this point with things like technology and the development of new products in the spaces of non-agency and the new scoring models for credit, like all of it. That's just, you don't want to miss anything, right? You get a little bit of FOMO, I think, if you miss too many of these conferences in a row. So they're coming back in droves. So that was, I think, really exciting to see. And it wasn't, 2023, 2024 was a little bit of freak out, or a little bit of just a negative tone, because there were still layoffs happening and lenders were still on average not making money. But now we're in a much better spot where everybody's brought back the right scale. They're implementing the right tools right now, and they're getting ready for the market to continue to grow incrementally, and just being prepared for that scale that's currently happening and could happen at an accelerated rate in the future. All right. Anything we missed, Kevin, Rhiannon?
That's good.
Great. Great conversation. Thanks for having us.
All right. Thank you too so much for representing us out there. And thank you for being on the podcast and talking through it this morning with us. And we will talk again soon. Thanks again.
Sounds
Jim.
good. Thanks.
And that's it for today. Join us next week for another episode of Optimal Insights, where we'll continue to provide you with the latest market analysis and insights to help you stay ahead. Check out our full videos on YouTube. You can also find each episode on all major podcast platforms. Thanks again for tuning into Optimal Insights.